Hello everyone, live from Nashville. It's Thursday, March 2nd, 2023. I'm Charles Brown, Portfolio Manager with CB3 Financial. We are glad you're here with us as we wind down the first quarter. So is October's low the low of the bear market? It sure looks like it, but the market has not done anything close to a V-shaped correction like it did in 2020. So that is why the pain sustains in this very long, what's now 15-month plus bear market. And big news from CB3. We told you about this over the last few tweets and Facebook announcements, and we'll give you that at the end of the program. All right. So, as you guys know, we cover a variety of topics. We look at the performance of our benchmark CG or capital growth account, cover the topics that are getting us that performance, as well as looking into the future and seeing what things could be like over the next month. If you're new to the program, please click on the subscribe button in YouTube and also click the little bell so that you get notified whenever we go live or upload a pre-recorded video. I also tweet every day, Facebook, Twitter, and LinkedIn. You can check us out there. Our next program, Thursday, April 13th. So a little bit of a gap between tonight and that because I am traveling next week. So this program is a week earlier than normal, but that is not the next program that I'll be uploading because you guys that were here in September might remember my interview with Tom Basso. Tom is coming back on CB3 Live for a special edition on or about March 28th. Tom's going to be discussing his brand new book, The All-Weather Trader, and I'm super excited to be one of the very first people to interview Tom. Tom was, made world famous, so to speak, in 1993 with the book Market Wizards, Jack Schwager's collection of interviewing top traders from all over the world. And he has been a very successful trader, investor in the market for 50 years. This is a brand new book, and I'm actually going to get a very extensive interview that Tom requested that I do for him. I think we had a real good time back in September when I did that one. So watch for that upload. It won't be live, but watch for that upload. And then, of course, the next show in April. So let's look at what's happening in the market. You guys know this chart. This is the 100-year story of the stock market. The secular bear markets, that means long-term, multiple business cycle bear markets, are in red. The blue lines are showing the secular bull markets. I continue to believe we are in a secular bull market. The green highlight there is what's been happening recently. So obviously, if you look back over 100 years, we are very definitely in an uptrend. It does not feel like it, and here's why. Since January 4th of last year, we have been in a downtrend, so that's basically 14 months heading into the 15th month next week of this bear market. But we have broken through this downward trend line. See the yellow lines? We have lower highs and lower lows. But that turned around last month. It hasn't done much since then. It's just sort of sputtered, okay, in the last several weeks. But I want to show you what this means, okay? You can see the momentum at the bottom there. The blue line shows that the market is continuing to gain strength even as the sellers come in and continue to dump stocks, all right? So what this looks like, again, zooming in on even a shorter time frame here, from last June, you see that, and there's actually no yellow line that goes all the way over to that, but that first low since then, which is 9 full months, we have been doing nothing but rotating from top to bottom to top to bottom in this channel. It is very difficult to make money or to see long-term growth in our accounts when the market is doing this. Obviously, we position ourselves for growth. So when this kind of trading happens, it's just very, very difficult. People are buying stocks, selling them when the market cycles up there. And you can try to participate in that if you want, but it's also very difficult to time this. It's very easy to see it on the chart when you look back at it. But in real time, much, much harder to realize. So there are 11 sectors, you guys know from watching the program. And it really helps when all 11 are going up. If you want to see a strong continuation of a secular bull market, at some point these sectors need to get in sync. So the good news here is the two greens, and really there should be three. If you look to the left of XLY there, you'll see XLC. XLC, XLY, and XLK are the ticker symbols for the three most important, at least bullish, sectors in the U.S. economy. That's communications, discretionary spending, and technology. But the other sectors are pulling these down, and that's why we can't go anywhere. I'll go back to this chart. This is why we're just oscillating. We have some strong stocks, and then an earnings report comes out. Tesla just surprised yesterday to the downside. You know, Tesla's a huge component in discretionary spending, and when it's floundering, everything's floundering. When Apple and Microsoft are floundering, that's floundering the tech sector. So that's why we're stuck here. None of the sectors are, well, some of them are obviously, but they're not all getting in sync. And we need to see that to really be successful. So the obvious question that people ask is, why in the world don't we just get out of the market and re-enter when things get strong? Rather than try to focus in on all these numbers, I just want to show you, and I've shown you variations of this over the years, but the percentage change from lows to highs, so this is looking at the low of a market date, going back to 1973, moving forward, and I could have included 2020 in here, but you guys already know that. I talked about that for well over a year. This is the percentage gain off the low of the market once the bears finally go away. And there's just very little selling because the sellers have been exhausted. Right now, the sellers are not exhausted, and that's why we are oscillating in that trading range that I just previously showed you. But you can see these are all double-digit numbers, and this is a nice percentage change, and you don't want to miss out on that. Most of that happens in the first 3 to 6 weeks of a recovery, because that's when people are panic buying because of FOMO. I'm sure by now you know that acronym, fear of missing out. All right, we want to be well positioned when the market finally does take off. It just means we have to sustain some pain until that happens, okay? You've seen this at the end of every section I do here. We're almost through with the earnings reports for the first quarter. All right, so we have 35 companies left to report, and we are below average. So 73, those of you that have been watching the program over the last 3 years know that that top line for above, meaning that these are the number of stocks in the S&P 500 that exceeded their earnings estimates. That number is normally 73. We've had some 77, 79s, never had an 80 when it's all done. But a 68, not what we want, but still technology at 83%. That's why that was the best performing sector. And it's actually been underperforming for the last year. So money's starting to move into technology, but we need more of that. We need more of this money that's on the sidelines to come in. All right. This is CG, Capital Growth. If you're a client of ours, every single client has at least a CG account, one CG account. And maybe GI and maybe Spec Op, but everyone has a CG. This is what it looks like, 179 roughly percent growth since inception, which is 2011. We had a great 2020, as you well know, if you were with us. And then you can see that blue line there at the end for the last 6 months is just sort of wiggling flat. And that's exactly what you're seeing in the market. So we are trading in and out, always looking for winners, limiting our losses. I'll talk more about that in the methodology section at the end. All right, I'm going to pause just for a second, get a quick sip of water, say hi to everybody. If you have questions, remember we're on about a 20-second delay, so send them in and I'll answer them as I get them if I can. Hey, Hossein. Hey, Debbie. Hey, Debbie Demigalski. 2 Debbies from South Dakota and South Florida. How about that? Welcome, you guys. Any questions, just ask and I will watch for them over in the chat. So the employment scenario, normally when I do the show on the third Thursday, and it's the reason I chose the third Thursday, is because I can, well, actually the second Thursday, this is the first Thursday. I'm able to comment on what the previous Friday's employment report was. All right. So not going to be able to do it this week. So I just have a couple slides here. So the non-farm payroll, which is coming out tomorrow, is expected to continue its downward trend. But look carefully. These are the expectations for employment. And you'll see that they're all above zero. So we may not have these huge surprises. See the blue lines that just jet above there? Like last month, we had this enormous surprise to the upside. All right. So the market is still expecting positive growth. It is really difficult to have a recession when the next year or so, year and a half, are projected to have positive employment. And even the jobless claims and planned layoffs, that line is flattened out here too. So we'll see what the number is tomorrow. Obviously, I'll report. I may do a mid-month report on that if it really is, market moving and worth commenting on. But the reality is that we are still positioned pretty well. So even with the market in a quagmire, word of the day, quagmire, we're still seeing pretty good data. So on the inflation front, U.S. consumer spending increased by the most in 2 years in January. That's because we're seeing a surge in wages, okay? So when inflation accelerates, that's when the Fed gets upset. So this is when good news is bad news. We had this discussion, I think, a couple episodes ago. There's good news, meaning good news in the market. There's good news in the economy, meaning bad news in the market. And that's what's happening here. Sometimes we get bad news in the market, but good news in the economy. And then there's bad on both sides, all right? But this time we have good news in the spending. Consumer spending is good. That's 67% of the economy. You guys know that from watching the program. All right. We need consumers to spend. All right. But if the Fed continues to ratchet these rates higher, it eventually affects consumer sentiment, which we'll cover later on. So inflation reaccelerated. It peaked in May. It started pulling back and then it ticked up just a little bit in January. We're waiting for the Fed numbers. Obviously, we just hit March here and the Fed numbers will be out in a few weeks, but just a little bit of a tick up, 1/10 of a percentage point, not that much, but it is moving up. And in fact, the core PCA, so PCE, this is without energy and fuel. So that is actually dropping. So we need to see these numbers come down because we want to have growth, but we don't want to have it at such a rampant level that people are willing to spend up, pay more, and therefore drive up inflation, okay? So you have to say, well, then how is that going to affect our portfolio? Well, it affects every asset class differently. So look here at bonds internationally. So that's definitely a negative, okay? It's a little bit blurry on the slide. I'm sorry about that. International bonds is the next on the left there. But if you look at equities, okay, so U.S. equities and international equities, really not that badly affected by inflation. Why? Because the companies that are in those indexes, whether it's the Dow, the S&P, the NASDAQ, or the overseas indices, they're raising prices to keep up with inflation. And if they raise prices, normally they're going to make a little bit more money. So as a consumer, you may not be too happy about that, but as a shareholder, you're kind of happy about it. All right. Obviously, commodities and gold tend to do better in periods of inflation. And when that happens, we do add commodity ETFs, exchange traded funds, in CG, and sometimes in GI when that is appropriate. All right. So month over month on the survey here, there's this, again, the personal consumption equity index here. Survey was 0.5, actual 0.6, so a little bit of a spike. I mean, it looks really bad on the screen here, but if you look, just even 5 months ago, it was negative. All right, so I don't see this as a concern. The PCE inflation did top expectations, and tonight's report really is a mix of good and not so good data, because that would be appropriate based on the way the market traded over the last 6 months that I showed you about, 10 slides ago. We are stuck in this quagmire, and we're not going to get out of it until the Fed backs off, consumer sentiment remains strong, employment continues strong, and then the money will come off the sidelines and really come in. So if you think inflation is bad here, I know it's tiny here on the screen, but this is just food. I just zeroed in not on the personal consumption expenditures, but on just food. So Argentina, 95% annualized inflation. Argentina, Zimbabwe, 285%. I mean, imagine that's like 0.75% every day. And you wonder why these third world countries can never get ahead. And it's because there's just insane, rampant inflation. And even, Lithuania, Hungary at 31%, Moldova, Lebanon, 142%. So when you think things are bad here, not even close to as bad as they are in an international context. All this said, what's the risk of inflation? I think it's not what we have been told in the media. No surprise from me, right? There's just not going to be a recession, according to the Atlanta Fed. Now remember, the Federal Reserve, there are 12 districts. One of them is Atlanta, and the various Fed presidents of those districts, some of them are more high profile than others. Chicago has a high profile, and New York certainly does, and Atlanta does. St. Louis as well. But they're basically saying, hey, we expect GDP to be 2.4% for the quarter, whereas January was only 0.7. So they're expecting to see significant growth in February when the data comes out. And then March, of course, we have to finish the month. And then in April, the data will come out. But all this is to say that our own Federal Reserve is saying, we just don't see it. Now, what's the Fed going to do with this? That's why I put this comment. I don't know how they handle that. Because if they think there's going to be a recession, they would be handling things differently than they are now. All right. I don't think that we're going to have a recession. I think when the Federal Reserve and the FOMC, the Federal Open Market Committee, meets and they look at this data from their various districts around the country, they're going to go, we really shouldn't be raising these rates anymore. I think what we've done has been pretty effective. At least that's what I hope that Jay Powell and others are going to do. We'll get to the Fed section here in just a little bit. So Bank of America data showed robust consumption in January. Already showed you that slide. Okay, so where is this recession? Look at this spike in January in spending. Okay, just amazing, really. Downward, credit card spending, et cetera, and then bam, up in January. Not even in December. Of course, that's usually a holiday month, but this is a positive sign that people are still willing to spend. And when you ask investors, what do you guys think about, having a recession? Well, back in March of 2009, 80% of people, and they were correct, we were going to have one. All right, April 2020, which was the height of the pandemic, actually March 23rd was the low of the market, about 80%. It was actually less than that now in November, just 3 months ago. And now it's pulling back already, so less and less investors. So we want to see government entities and corporations and private investors all thinking that a recession will not happen. Why? Because it improves consumer sentiment. When consumer sentiment improves, people tend to want to spend. When they spend, companies make more money and their stock prices rise. You guys follow that? Okay, that's how it works. Goldman Sachs, pretty smart company there, all the way to the left. Look at the little gold bar, get it? They do not see a recession. They just think the risk is relatively low. They're looking at the same data that I am. They're far smarter than I am, but they've been saying now for many months, and yet there's still plenty of forecasters on the right side of the screen there. Some of them with a 92, one of them with a 98% chance of a recession. A lot of things are going to happen for a really serious recession to happen. A lot of negative things are going to have to occur for a recession to happen, and so far, not there. Now, I'm not convinced that the market believes that, because you can see from the performance in your accounts and the charts that I showed you earlier. Again, word of the day, we are stuck in this quagmire, which eventually we will get out of. And I assure you, we will be on board when that happens. We will not be standing on the sideline in cash hoping for a pullback. Been there, done that in 2009. All right. So the market implied, this is the actual data, usually expressed in options trading, odds of a recession tumble. So in October, pretty far over there. January, you can see the yellow line. So when the yellow line is to the left of the black line, that means the more recent data, which is would have been last month, January, but let's call it 5 weeks ago, less and less market implied data saying that we're going to have a recession. So folks, that's the data. You can believe me. You can believe this data. You can believe the news entities out there, the corporate news, but that's the data. Recessions are not good for the market. Markets power through them and they don't just shut down during a recession. But right now, the market is processing inflation and much more concerned about that than they are a recession, because that's what the data says. The reason we cover politics is because it leads to policy, and policy affects our portfolio and our personal lives. So let's get right off to the start. 2024 is just next year, the next presidential election, and let the snarkiness begin. Biden, Fetterman, the 2024 ticket. It's a no-brainer. Trump, 24 years in prison. So there's something to amuse those of you on the left or the right. So the Senate votes to block Biden's ESG. You might not be aware of this acronym ESG. So that's environmental, social, and governmental investing. All right. This is something that Ron DeSantis in Florida really got on the case of his legislature there, and actually pulled money from BlackRock because they were so ESG conscious. I am not a fan of ESG because I don't think it has any place in investing. I think you're muddling up social cause, wokeness, if you will, for investing. I think those two need to be handled separately. We want to look at an investment purely for what it does for the shareholders. So the Senate, believe it or not, voted to block this Labor Department requirement. Now, the Senate's controlled by the Democrats, but Joe Manchin from West Virginia and John Tester from Montana, both senators in very red states, voted against this. So now it's going to take Joe Biden vetoing it. And then, of course, it's going to go to the Supreme Court, and we'll see what happens there. But these sorts of things do affect us as investors. So I heard Joe Biden the other day saying, I want you to know one of our best accomplishments has been a reduction of the deficit by 1.8 billion. Well, that was a slip. It was 1.8 trillion. But the only reason that deficit was reduced is because all of the benefits that have been mailed all over America in 2020 and 2021 ceased. Okay, so that's why the deficit went away there, and that was not brought out. But this is the truth. These are the sources that I'm going to. The Treasury, okay, and the Congressional Research Service. Biden has actually increased the national debt by $4 trillion in just 2 years. January 2021, when he took office, the national debt was 28 trillion. Today it's 32 trillion. So these are the things that weigh on sentiment. These are the things that voters need to be aware of. Again, cross-reference my data, folks. This is it. We need a government that is lean and mean and trying to support businesses and encouraging entrepreneurialism. That's what sets this country apart from every other country, in my opinion. So this is the current breakdown of what we call trifectas. A trifecta in a state or at the federal government means the president, the Senate, and the House are controlled by one party. That's what happened the previous 2 years, and it's not the case now because the Republicans won by just the tiniest margin. So we have split government in Washington, but the same thing applies to states. It's just there instead of a president, it's a governor, the Senate, and the House. So you can see the number of red states. It's interesting to me that there are gray states where it's split, and those are some of the same states where the voting was very close in the previous two elections. So how does this affect us going forward? Well, in these states where you have government all on the same page, things can either get really good or really bad. And again, it affects consumer sentiment. People spend money when they are confident that they can make money, spend it in the market, and the government's not going to take it away from them. There's a reason that these big blue states are losing residents, and that's because of the high tax rate. So we need to watch this, see what it looks like going into 2024, but that's what I'm seeing. So do you think America's a weak nation? I hear this a lot. So I put together some data here, and this is evidence just over the last 100 years, all right? Now, I realize great's an overused word, but here are some examples of how the U.S. has excelled and what makes us different than any other country in the history of humanity. We defeated Hitler and Tojo, Japan, at the same time in World War II, freeing tens of millions of people, collapsing the Soviet Union. Thank you, Ronald Reagan, and Mikhail Gorbachev, for that matter. Crushing the jihad. Thank you, Donald Trump. Okay, accepting hundreds of millions of immigrants and providing opportunities for them to have better lives than in their countries of birth, and that's a thank you to many presidents. We have by far the highest standard of living on the planet. For all those that complain about how bad this country is, that is why there are so many, literally hundreds of millions, trying to get into this country over the last 100 years. All right? And providing trillions of dollars in taxpayer money to the poor so that they will have a chance to rise to the middle class. There's no other country out there that's done that. So that's my comment here. I think this is a plus for America. When America is doing well, when its citizens, that's us, feel good about how their country is doing, it affects their mindset. When it affects their mindset in a positive way, that's good for spending. When spending is strong, it makes stock prices increase. All right? All right. Questions? Thanks for the happy birthday, Charles. Appreciate that. Debbie, I understand. We have people that are fans of Ron DeSantis and others that are not. It's funny that Charles Todd and Debbie are right there on the screen together, because I believe Charles Todd is a big fan of Ron DeSantis, but he did win re-election by 20%. We will see what happens. He clearly is running for president, as is Donald Trump. So that's why I said on the screen, let the snarkiness begin. It's going to be an interesting season. When I get to the economic section, you guys know what I do here. I look at what I'm seeing and what could change the trajectory of how the market's performing over the next, 3 to 4 months. All right. So U.S. business activity rebounded to an 8-month high. So you see a little red dot I put on the screen there. It was heading down, but now it's rebounded. It didn't drop all the way down to where it was in 2020. So that's a strength. That's a little piece of data I'll be following. The survey for this PMI, or Production Manufacturing Sector Index, was 47.2. It came out 47.8. So that's a good piece of data. ISM, new orders, again, ticking up. You want to see this kind of data. All this translates into more formative data when you actually see the employment numbers and GDP numbers, etc. So month-over-month PPI, the survey was 0.4. The actual number was 0.7, the little red bar there. It's a great thing. We need our companies doing well, Producer Price Index, all right? So 3 entities make up all of GDP. That would be the consumer, corporate spending, and government spending. By far, the most important is consumer spending, but government spending and corporate spending is also important. So I'm still seeing household excess savings at a pretty high amount. So people will spend even if they have to create a deficit lifestyle. But right now they're spending from savings largely from what they socked away from what the government gave them during 2020 and 2021. All right. So that's a positive. It means there's money in reserve. If people want to continue their lifestyle, they've got it in their savings to draw on. All right. Consumer sentiment, University of Michigan's most famous survey here. It was expected to be 65% last month, came in at 66.4. So it hit a bottom there in 2022, and now it's bouncing off of that. Interesting with the consumer sentiment negative was actually worse in 2022 than it was during 2020. And that is because, in my opinion, that recession and market pullback happened so quickly that people just, got over it. But the sentiment, what makes it difficult to hang on emotionally during a downturn that's 15 months long is this bear market that just doesn't want to move anywhere. I'm going back to my word quagmire, right? So when I see this consumer sentiment number, I find that encouraging. The other data that University of Michigan does and produces every month is the financial situation. So they ask people, are you in a better position financially than you were a year ago? And that number's increasing. All right. Again, reaching a low in 2022, not 2020. So this is what we need to see. Continuing consumer sentiment, financial situation, people believing it's the old question, that Ron Reagan asked Jimmy Carter, are you better off now than you were 4 years ago? Just ask yourself that. If you are, then vote for him. If not, vote for me. That was Ron Reagan, and he must have connected with people on that. So, all right. Do I think the figures, the numbers being reported by the Fed and government are accurate or the truth? I think that's a good and a fair question, Charles. I have no way of knowing if they're truth because I don't have anybody on the inside. What I can tell you are two things. When the market reacts tomorrow morning to non-farm payroll, there's going to be a huge move up and down. It's going to whipsaw back and forth. And if that number were known ahead of time, if it had been leaked, there would not be all of that because people would have front run that. Traders would have front run that number. All right. So I think in that regard, it is truthful. The second point is to make that when you see something negative, like last month, the Washington Post had a report on Biden and accuracy of what he was saying, and they were actually pretty down on him. So I tend to trust negative assessments from people that I would expect to be positive. I don't know if that makes sense, but if I'm expecting the data to be good and the data is not quite as good, then I think it's probably more believable, it's probably more conservative. But the truth is that there's corruption all throughout the government. All right, there's just no question about it. There's corruption all throughout humanity. That's the reality. So, but regarding the Fed, when's the last hike? Well, most participants, about 35%, are saying May 3rd's the last hike. And then we have a series, I should say, of cuts in the Fed funds rate. And that's what we want to see. Jan 14th, next most popular. And then we move into, obviously March 22nd, pardon me. That would be this coming March 22nd, saying that that's the last cut. I think I'm on board with that May 3rd. The reality is that the bond market, is selling off because that's why yields are going up. Remember, bonds move higher, yields move lower, or bonds move lower and yields move higher, and that's what's happening. I mean, we've got a 2-year yield running near 5%. Just a few years ago, candidly, during the previous administration, we didn't have rates anywhere close to this high, anywhere close to them. All right. So the market, I talked to you about the investors and the fund managers, what they're expecting as far as from the Fed, but investors, public investors, are expecting at least 3 more 25 basis points. So we'll see. I thought the next interest rate rise was going to be, or a hike, I should say, is going to be 25 basis points. I think now it's probably going to be 50. And then they'll have a couple more 25s, and then they'll just stop probably at 5 to 5.25 and see where things are. And that's high. I mean, it's not high historically, but psychologically, it's high compared to just 2 years ago. The Fed funds rate was 0.25, a quarter of 1%. All right. All of this has happened really, really fast, and the Fed has not handled it well, without a doubt. I showed you this chart, or a similar one. We've updated it. This is Nomura, so they're an investment research or forecasting company. They are expecting, and they are right a lot of the time, even though the Fed projects that the FOMC meeting in December of 24, okay, so that's just a little less than 2 years away, 22 months. The Federal Reserve is saying, yeah, we're still going to be around 4%, but Nomura says not a chance. We're going to be down at 0.75. I sure hope that's the case for the housing market, because it is really tough out there for people trying to buy a first home or even refi, or to move from one place to another, because rates are just so high. And the last month saw a huge move from variable rates around 5 3/8 to 6 1/8, 6 1/4. But Nomura, who's a pretty reliable forecasting entity, thinks that this is going to drop. I hope they are correct. Believe me, if this happens, the stock market will light a fire. So the housing market, home sales posted the 12th straight monthly drop. So we've needed that. I mean, it's tough if you're trying to sell your home, but the house price inflation, which had just gone rampant, and this is all over the country, not just red states in the South. It was in New York City, San Francisco, LA. I don't know about Chicago so much, but all over the country, there was just a logarithmic increase in housing prices. Just crazy. And that's 12 months now of lows. So what you're seeing with this going high, I'm talking about things going lower and you're seeing a line going higher. This is the number of housing inventory. So inventory is rising, meaning it's not selling. So they're staying on the market longer. There was a rush of homes to get under contract in January, largely because interest rates pulled back a full percentage point lower than where they are right now. And then they hit that point around, I think, maybe 5 3/8, and then just went way, way higher than that. So we'll see when the data comes out. And then when I get to you in April, we'll have much more information to work with as far as late Feb and March sales. But I don't expect the pell-mell to get into houses to continue anytime soon. It will come back. Obviously, residential real estate is still a great investment, but we've got to sort through things here first. So existing home sales fallen the fastest in this hiking cycle. So this is charting what happens when the Federal Reserve raises interest rates, because when that happens, it makes it tougher to get a loan. You can see the big green line from September of 2005. Not what you want to see. Obviously, the inventory increases, home sales decrease, and in the current cycle, from October of 2021, which really is when this headed downhill, it's gone down faster even than it did in September of 2005. So it's on track to be the worst performance of housing sales during a Fed hiking. And of course, that's because the Fed did 4 75 basis point hikes back to back, the first time ever. And I'm sure that they wish they had rethought that or maybe do it differently. But nonetheless, we will get through this. But that's, if you're wondering why houses are sitting out there, that's why. Still, there are fewer and fewer distressed home sales. So people aren't just giving away their homes, largely because they don't find themselves underwater, which is what happened in 2008, 2009 during the financial crisis. People put nothing down or 2% down, and then they quickly got upside down as housing prices dropped. But that's not the case now, and we're not seeing an increase in distressed home sales, which is a good thing. All right, let me pause for a second. Any other questions from anybody? All right, I think I've got everything here. Grab a cough drop. All right, so we started in January, and now I think this is the third month where, this would be the third month, right? January, February, March, where I talk about our methodology. We used to buy and hold, hold on for dear life years ago. That has changed, and that is because when we get in these quagmire markets that just oscillate for months and months and don't go anywhere, it's very easy to just hold a stock that's not doing anything. It's taking equity from the portfolio. In other words, it takes money to hold that stock. But right now, and actually for the past half a year, 9 months or so, I have tightened up the stops on how much I'm willing to tolerate from a growth stock. And at this point, that's 1% of the portfolio. So if you have a portfolio that's $100,000, I'm going to risk $1,000 to buy a stock. Now, I have stops in the market whenever I buy a stock. And if I'm risking $1,000, I'm not risking the full value of that stock. If it's a $8,000 purchase, I'm only going to risk $1,000 of that, and then it gets stopped out and we look for something else that's going to perform better. So what this does is requires limiting most of our stock positions to 2, 3, or at the most 4%. For years, we had stock positions as high as 5, 6, even some 7s, which we're just not doing now because of market behavior. That's the sort of thing we've had to do to adapt to the market conditions of this unusual, cyclical, not secular, but cyclical, very long-winded bear market. All right. This results in growth being a little bit slower, but it's just what we need to do. So we track metrics. We'll end up taking smaller profits. We'll end up exiting stocks. Again, as I said earlier, if you look on the screen, I don't know if you're on a phone, you're probably not going to see this, but that profit to loss ratio, we're at 3.9 to 1 in CG. But that also means that only about 22% of the stocks that we buy actually end up being profitable. And that's because I take stops, as I said earlier, on a stock that's not performing. If you don't do that, you end up buying a Facebook and seeing it drop 69% in 1 year, which is what happened last year. Now, have they recovered? Yes, but that's hard to hold on to that. So I'm not doing it. Now, there are other portfolio managers that have had this sort of strategy for years. I worked on it for 4 to 5 months, scientifically, so to speak, mathematically, working out a process here. And I have software now that helps me track this. But just so that you know, there's no more hodling here. Hold on for dear life. We enter with a stock. We expect it to do well. If it does not, and it hits that 1% threshold. Now, obviously, and this happened today, we had a stock that was down about 0.5%, and then it gapped down 14% at the open. So there's really nothing we can do about that because it happens overnight. But for the most part, we're just trying to reduce risk. I do believe that when we got out of this ninth time tonight quagmire, you're going to see stocks shoot up just like they did in 2020. And for those of you that were investors with us in 2020, you remember that CG had a 62, 63% return, depending on whether you were in that program or when you got in that year. So I don't think we're going to see that this year, but I still think we could get a very strong return once we get out of being stuck. The bears are holding on. They know that downward trend line has been broken to the upside. You saw that very early in the program, but they're holding on. There are a lot of people that are still selling. And when everyone has sold that has to sell, there's nothing left but buyers. And that's what makes secular bull markets resume. Okay? My thought for the day, retirement should be a second life, not a waiting room for death. Not sure how I came up with that, but it just was on my mind. So look forward to the next years of your life, okay? We're not just in there in the waiting room for death. We're not just playing shuffleboard. Not that there's anything wrong with shuffleboard, but let's keep an active and busy life. And of course, that's what you've got me here for to do, is continue your investments to generate income for you, to generate capital growth for you, so you can live on them and have a happy retirement and not just be waiting for the doom. All right. So reminding you again, this is going to be a great interview. It's going to be a great book. This book is mostly psychology because investing is mostly psychology. I know, and I've talked to a bunch of you guys that you're just worn out by this particular bear market. The 2020 didn't bother you because by the time it was like, well, here we go in a recession. Oh, wait a minute. Now the stock market's up 18% in 3 weeks. Yeah. And then you just sort of forget the mindset, right? But this one has gone on and really feels more like 2008 and 9. It is not as deep, anywhere close to as deep, which hit about 53 to 54% between the S&P and the NASDAQ. On March 9th, 2009 was the low, 676.53 in the S&P 500, long time ago. All right. So look forward to this, and we will interview Tom and have a nice interview. And I think there'll be a discount on his book if you want. And again, it's something that you need for your mental well-being, in my opinion. So that's what we talk about here. Those of you that are new, tell your friends. Market review, economy, recession, inflation, economic indicators, the Fed, always U.S. policy and housing market, and our methodology. Come back and join us on April 13th. So what is the big news that I've been hinting at? All right. Well, for 2.3 years or so, we have enjoyed and loved living in greater Nashville. We live in a place called Brentwood, and we love the climate. We love the food. We love the low taxes. Okay. Love the weather. Love the hills. It's just a phenomenal place to live, and I would highly recommend it to anyone as long as you have family here, which we do not. What we do love even more than our home in Nashville is being grandparents. Alice and I are grandparents, and we have our 10th grandchild, of course, coming to us next week. And we have no family here in Nashville. So we have thought about it, we have prayed about it, and we have made the decision that we are heading back to Chicago. Welcome back. We've been there 33 years. We took a 2-year break. We took a 2.5-year break, maybe 3, in Wisconsin, but we were still really close to Chicago. But this time we're going back to good, and we're for good, I should say, and we're doing it for family. We're doing it for literally decades worth of friendships, and we're doing it because 70% of our clients still reside in Illinois. So those of you that are there, I'll be able to see you more frequently on an easier schedule. You don't have to try to line it up when I'm coming into town. Those of you that want to come in and see us, hang out with us. It is easier to get into O'Hare. Obviously you don't want to get snowed in, but it's easier to get in there than to B&A. But, Nashville's airport's really a quaint and growing airport. So that's the big news. We are excited to go back. I think it's going to be great for us as parents and grandparents, 3 children, 3 grandchildren there, and for our friends and for our clients. I'll be active in the CMT. You guys see that at the end of my name there. So Chartered Market Technician. I'll go back down into the city every month for symposiums and meetings, and looking forward to being engaged back in the financial community there too, which benefits you guys. So that's the big news. So the next time that I log on, I will be saying live from Chicago, like I did for 2+ years. As we end this program for the last time in Nashville, and as I do every time, for we have not been given a spirit of fear, but a spirit of power, love, and a sound mind. We really appreciate you guys joining us. We're in our 4th year now. We've been here for 2 and 3 months or so. Had a lot of shows here, a lot of good interviews, a lot of good things happening. Loved our life here. Appreciate you guys tuning in, telling your friends about the program. Please remember that at CB3 Financial Group, we don't just manage your assets, we become one of them. God bless you here over the next 5 weeks. We're going to be heading up there next week, getting moved in. We'll be back in April. Remember the Tom Basso interview. Just click the bell there in YouTube and you'll get notified when I upload that interview. I'll look forward to seeing you guys back home in Chicago. Good night.